Good morning, ladies and gentlemen. Well, we had a very interesting week, and the only thing that I care about in the model score is the fact that A, it never went negative, and B, it's now not going very positive. That just tells me that we are in a big range. And why are we in a big range? You can tell the model score from here. So if it goes negative, you can see it, and if it stays slightly positive, you can see it as well. Everything else is mathematical, so it really doesn't matter at the moment. But what is interesting is that the market is basically responding to data. As soon as you get a weak number, the market is on recession watch, and as soon as you get data which disproves the previous data point, the market rallies like crazy because it's no longer on recession watch. And this will continue. This is a period in which we are trying to ascertain whether we will go and have a recession or whether we will have a soft landing. This will not be determined this week or the week after, so a continuation of up and down is what I expect here for risk assets. The yield curve, both in 2s10s especially and in 5s30s as well, is the one that is showing you the way for risk assets. Steepening and you get an accident, and then the flattening back and you get a relief rally in all risk assets because it's like not yet. So what to expect here? I find it very, very difficult to believe that the yield curve is going to go any better than this 27 area here in 2s10s, and then we go some more. I'm not playing the yield curve anymore. I am looking for it to give me direction. If we get to this 27 area, I will be looking for any sign that we are ready to re-steepen. But I don't think the data this week is going to be all that important because A, we have very little of it, and B, because the market will be looking through into Friday for Jackson Hole and the speech by Powell. I don't think the speech will be consequential. I think it'll be technical, and I think he'll be saying more or less steady as we go. We're hoping for a soft landing, and we will at some stage remove the policy tightness that they all keep on talking about. It's not really important whether policy is truly tight or not. What is important is that they want to remove the tightness and therefore go to a neutral policy level. And what is a neutral policy level? Well, basically what the dot plots say. The dot plots are saying, 2 cuts this year and 4 more cuts next year, which take us somewhere to around the 3.75 to 4% area. And if that is the case, what happens? Well, the yield curve either stays where it is or slowly steepens. Therefore, from upper levels like that 27, 28 area, or God forbid this 32 area, the risk reward is for steepening. So now if we look at the equivalent in the 5s30s, that would be somewhere around here, wouldn't it? 30 area. From minus 30, the risk reward then becomes really good for steepening again. And what does that mean for risk assets? Well, it means that the upside is now capped. I will naturally go through what the equities did last week and why, but I really expect the upside from here to be very, very difficult to penetrate, and really the risk reward from upper levels becomes for risk assets to give up some of the gains of the last couple of weeks, just as the bond market gets ready for more steepening at some stage. Before I go into the individual tenors, let's have a look at what the pricing is in the short end, because this is the one that doesn't really make much sense at the moment, and the one that I prefer to be short of. So up here, I've indicated the cut in September, which I think is now 100% baked in. It would have, we really would need to have some amazing data come out for that not to be there anymore, or for that to become a 50 basis points. I think that it's very, very unlikely. And then I've put a cut in December, and I've put the extra 4 cuts that they're looking for in 2025. What I haven't done is I haven't changed their dot plots at all, because I think in September, when the dot plots come out, this is really what you're going to see. So here we are. We are basically between 30 and 50 points rich all the way into 2025, late 2025 and 2026. What the Fed is telling us at the moment is that unless the data is very weak, the cutting cycle is going to be to the 3.75-4% area. To look for it, and it's more than priced in. So to look for further cuts, I think in the sofas makes no sense whatsoever. I think the sofas are likely to remain offered simply because the need for rapid cuts is really not there at the moment. We really would need very weak data. And then what happens? Well, if we should be trading 95.90 and we're trading 96.42, that's 50 basis points. So we really need a huge amount of weak data to justify this pricing. So I think slowly over time, this comes back. As the data shows no recession, this comes back. So the likelihood of rapid steepening of the yield curve from here is only if you get very weak data. And okay, if you get very weak data, you will get some steepening, but it's unlikely to be very rapid simply because we have so much priced in. So I find it very, very difficult to see that the bond tenures that I'll cover next are going to make new lows in yield and new highs in price. So let's have a look at the individual tenures. And this is now the 2s. I find it very difficult to believe that we are going to trade down to 369 again anytime soon. That was the emergency kind of stuff, and now we are slowly making our way up to these levels, 420, 426. As I told you, 426 is where I don't believe we will trade above. This bar here is the last FOMC meeting. Then we had this bar here being the NFP that basically has been negated by the weekly claims, 2 sets of weekly claims that we've had, and the retail sales. So what have we done? We panicked on that Monday, and we've come back to basically say the NFP was dubious. What happens next? Well, I don't think that we will go through this 426 area anytime soon. We would need to get very strong data for that to happen, and I doubt that we will. That to me is the line in the sand. That's the previous close of the FOMC, and really there is a big difference between the SOFR that I showed you earlier and the 2-year. The 2-year is going to trade more or less on what it assumes the terminal rate to be. And if it's in no doubt that the Fed goes into a cutting cycle, and September will be it, the likelihood of the Fed's cutting cycle being one cut and done, because data shows otherwise, is very low. And therefore, the 2-year is not going to respond nearly as much as the 2025 SOFRs, or even the 2026 SOFRs, which are far ahead. So I much prefer to buy the 2-year at 426 than to buy any SOFRs. In fact, I'm short of SOFRs at the moment, and I think any kind of move to this 426 area is probably going to be the last bite of the cherry that you get in the 2-year note, and then the 2-year note will basically settle from that being the upper range to about 390 being the bottom range, until and unless we get real recession data, in which case it can go a lot further and SOFRs can go a lot further, but the SOFRs already priced that in just about. So the 2-year note is a much, much better risk reward. Now, what is going to happen to fives? I think the fives are going to back up quite a bit. I think this is going to be an ABC kind of thing, and they're going to come back towards the 404 area, simply because if the Fed has no reason to panic and you get the terminal rate confirmed in the next dot plots, why would the 5 years panic? There is absolutely no reason. If the Fed funds are going to be 3.75 to 4% towards the end of next year, why should the 5-year note be below that level of Fed funds? I just don't see any reason. So to me, the likelihood is that you buy the 2-year note at 4.25 or maybe 1 basis points higher. You leave the 5-year note alone, and you leave the 10s and 30s well alone as well, because they could easily go back towards 420 with issuance. The only reason why they wouldn't is because the data is really, really weak. Are we getting that really, really weak data? No, we're not. So I just can't see the value in these higher higher durations. I just don't see why we need to panic and buy duration. What is the hurry? It's not like we're not going to have auction upon auction upon auction. The only reason why these would rally substantially from these levels is because we get recessionary data. And recessionary data will be reflected much more in the 2s in any case, so I really don't see what the rush is. The only reason why I'm not short the longer tenures is because of this chart, and this is basically real yields. I think real yields are too high. 177 when the Fed wants to remove tightness and go towards accommodation, or if not accommodation, neutral, I think really needs to be somewhere in this range. It needs to be around the 1.5 area. So once we are 125 to 150 area, that is when I can start shorting the 10-year note. This kind of area, I'll be happy to start shorting the 10-year note. At the moment, I'm not. I think real yields need to come down. I think 125 to 150 is where they belong. And if you do the maths, that's, if you say it's, 2.5 inflation, that's 3.75 to 4% should be the 10-year note, and we're not that far away from those levels, right? So if it goes through there and real yields achieve this 125 area, that's when I can say I don't really want to be in longer duration stuff anymore, and I can short it. But until that happens, I think the likelihood is that bond prices keep on trying to do better. They won't do substantially better, but they will keep on trying to do better, so there's really not a lot of point in shorting them. Europe is basically on holiday, and here too I really am not enthused by the price action in anything. I think it's more likely to come back slightly on disappointment that nobody's panicking, as it were, but it's not going to go a million miles to the upside. Any kind of level here in the bobble 228, and we are very ready for another fall. It's going to be that kind of a market where it just reaches short of the level that you really, really want to get in, and then goes back and then just fools you. I think there's very little to do in Europe at the moment. It's just following the States, and that's it. The only thing that I would really get enthused about is if we see this 241 level again in the Bund, i.e. in tens, but I think the likelihood is very, very low because there's really very little going on. This could be an ABC, and this kind of 238 to 241 I would be interested in. But otherwise, if you look at the way France is trading or Italy is trading, it's basically telling you that there is very little likelihood of a large move anytime soon because the data just won't support it. What is interesting, though, is that Italy against Germany is remaining in this lower range, and that Germany against France is not going further out. So stability. This would really start going out if we had some kind of an accident in risk assets, and it's not. It's nice and stable. So this tells me that stability in risk assets is more likely than any kind of new panic. And if that is the case, triangulating with what I said earlier, you get stability in the US yield curve, i.e. it's unlikely to start steepening hard, and therefore there's very little reason to think that risk assets are going to fall hard. That's really everything that the bond market is saying at the moment. If we look at the cross between tens in Germany and tens in the US, this is a pattern which to me indicates that sooner or later we trade this 152 area. We might have another go at 172, but it seems that it's trading technically very well. It keeps on staying below this 172 with rallies to 172, and that to me indicates that we trade towards 152. That coincides with what I think about the US tens and why I'm not short of them. That the US tens keep on trying to do better, and once we're down here we can bounce back up towards 172. This to me indicates two things: A, continued weakness in the dollar, and B, that the US continues to lead and try to lead bond prices to better levels. But it doesn't really go very far. I mean, this is 11 basis points. And having looked at the Bund could easily move not a lot. And we are really looking then for maybe 15, 20 basis points max in move in the tens. So it's really not all that inspiring. But most of all, it tells me that the likelihood is that the bond market in the US keeps on trying to do better, keeps on pushing, and eventually runs out of steam. And the net result is that the dollar is weaker. The dollar I don't like. I think this 101.92 level is going to be key. I think it's going to hold for a while, and then I think that 99.79 is going to trade, but it will hold, and then we bounce back to 101.92 or maybe slightly higher. So I don't think the dollar is a disaster, not in the short term. I think it'll hold these levels that it's basically held since the mid of 2023. I don't think it's any kind of fall to much lower levels is imminent, but I think that over time the dollar is going to then fall. And I'm talking about, I don't know, 6 months out or something like that. No way am I looking for enormous falls, but I'm certainly looking towards the market going back towards below 100 and remaining below 100. And that really should be good for emerging markets, assets, and the rest of the world. So as the Fed normalizes and possibly even goes to accommodation, the dollar just basically starts losing value against other currencies. We've had a long period, in which the dollar has been, and basically from here, so from 2022, when the Fed started becoming tight, and look where we are now. We are basically where we were when the Fed tightness started coming about. So to me, this is a longer term thing that tells me that the dollar is beginning to lose some allure here, and that it's probably time to look at what the emerging markets are doing because they always do much, much better when the dollar is not necessarily weak, but not appreciating. I think gold is sensing that the dollar is losing some luster. And I think it's also sensing that real yields are going to be in that range that I showed you earlier, around the 1.5%, and it's making its move. I guess it needs to go, whatever this is, 150 to 200 higher, and then it's going to come back. Whenever it does this and it breaks the Bollinger Bands to the upside, you can see that it has a couple of weeks of breaking higher and then it comes back. So I expect it next couple of weeks to trade from this 2540 area, maybe all the way up to 2650, 2700, and then come back. Because I just don't think that the dollar move is necessarily impulsive at the moment, and I don't think that the real yield move is necessarily impulsive at the moment. But gold being a much smaller market and much more easily moved and manipulated, it will probably go first and then go sideways while the others catch up. So that is my explanation for why gold is strong at the moment, and I can't see it collapsing next week. I think any time that it comes back towards this 2460, 2430 area, there's going to be a ton of buyers. So I expect it to continue going simply because it's such a small market and it's sniffing what I think is not necessarily huge weakness in the dollar, but a period of continued weakness in the dollar, i.e. not strength in the dollar. Because as I showed you, I'm only looking for like a couple of percent over a considerable time frame. I'm not looking for a collapse in the US dollar. And therefore, how far can gold go? Well, it can certainly go another 3, 4, 5%, simply because it's a much smaller market. And if I can't sell 10-year notes because I think real yields are going to go down another 20, 25, 30 basis points, then gold is going to be supported. DBC really is being a pig. It's going nowhere. I would leave this well alone until it has a weekly close below 2175 and hopefully not a 2174 close, because that really would mean nothing. So look at it in terms of gold. The trend is definitely there. It looks like it's just going to bounce around, and we just don't know where this goes. This could easily be some kind of a bear flag that goes upwards, or it just breaks and then goes down to these 1868 levels. I just don't know. The fact that it can't move anywhere and basically is where it started the year tells me that the pressure is not on commodities, and therefore that inflation is going to be tamer, and therefore that I see absolutely no reason to be selling bonds until they are at real yield target. And look at what gold is doing against DBC. It's basically telling you that, buy me. Don't buy DBC, buy gold. And how far can it go? Well, it can go a long way. That's all that can be said for it. I don't think it'll go much further than here, for example, or even this level. But even that is another 10%. So you're looking for much bigger moves upside in gold than you are in DBC. So why not trade gold to the upside and leave DBC well alone? Before we start the review of the equities, I want to have a look at RPAR. Now, RPAR is making new highs on the year. And don't look at this. This is wrong. I have included a link to what it actually holds. It basically has some long duration bonds. It has equities, mostly defensive equities, and it has about 10% in gold. And I think that RPAR is likely over the course of the next couple of months to trade in this 2033 to 2069 area. And that tells me that bonds are going to remain bid, so that's why I'm not selling the long duration. And also tells me that equities are going to do just okay. And gold might drive it. But, this kind of behavior where it dumps and then makes new highs tells me that there is some impulsion here, or at the very least that we are going to trade in that area, and therefore that risk assets as a whole are not going to be offered. And also a quick look at ITOT over government, so the totality of the bond market against the totality of the stock market. And this is exactly the kind of behavior I was expecting a couple of weeks ago. A quick dump, back up, consolidate, and then decide. I think we're now in the consolidate before the decide, but I still think that over time it's going to go higher. I don't think it's imminent. I think this 530 to 5 area is going to be where we stay next week, and therefore I'm looking for stability in stocks at best rather than a move to new highs immediately. So let's have a look at the clean chart of the equities. This kind of move, this V shape, just tells me that the pain trade is really to fill these gaps up to this 56.30 area. We're 70-80 ticks away. This kind of thing just go sideways and then correct down and then go again. I really don't think that next week we see new highs. I think this 56.40 level next week is going to be very, very difficult to break. But the fact that we broke 54.47 also indicates that in no way do I think that we revisit the lows anytime soon. I think we're much more likely to trade between 54.47 and this 56.35, 40 area. Unlikely that we get any kind of information next week which gives us the impulsion to go one way or the other. What I do think is becoming interesting is EEM and those markets, those emerging markets as a whole. As I told you at the beginning, they tend to do a lot better when the dollar is in a period of weakness. So this kind of behavior, and let's try and enlarge it, is really telling you that this 39.93 level is unlikely to be broken, or that the market will not trade below it. We are now looking for this market to make new highs to around 45.04, and that really will mean that over the course of the past 2 years we have made some kind of a base. A market which makes a base over 2 years eventually breaks higher, and I would not be surprised if this market starts outperforming and going towards 50. Now that's a big move. So I really think that this market over the course of the next, I don't know, 6 months or so could be doing significantly better, certainly up towards this 48 area. That is where I would like to let go, if you know what I mean. But now I'm in an accumulation mode for EEM. The Nikkei on Friday put in a doji, which probably means that it trades between this 36.3 down towards 35.7, this kind of area, up to this kind of area, 39,000, 39,100. That's the kind of range that I see it for quite some time. I don't think this is a topping pattern. I think this was a very quick correction, and really it's getting ready to consolidate before it makes another attempt at the highs, would be my guess. Much like the fact that Europe has returned to the scene of the crime, which is 48.50. Very quick, very, very strong move down, reversed in no time at all. That tells me that it's unlikely to repeat the move, and that any move down to 47.70 is going to get bought for another attempt at the highs towards the end of the year. So all these other markets tell me that equities as an asset class are unlikely to remain very weak for very long. Volatility has basically returned to support. And as you can see from the weekly chart, whenever it does a stupid move, it then spends a couple of weeks at the lower levels before trying it again and coming back down. So I don't expect any kind of, how shall I put it, violent move for another couple of weeks. And that tells me that we are likely in a period of sideways to up. And that tells me that we are basically in a period of sideways to up in equity prices, and that any dip is going to get bought in equities, and that the pain trade is some kind of a wedging upwards in prices in equities, but with outperformance by the markets which are most affected by a weaker dollar or the prospects of a weaker dollar. And those are emerging markets. And I think that those are more likely to make impulsive moves than the S&Ps. So to sum it up, I'm really not looking for very much from the bond market. I really don't think that we are in a position to start steepening in the yield curve at the moment, which tells me that equities are going to be supported and that people will be buying the dip in equities, and probably they'll be buying the dip in the emerging market equities more than they will be buying the dip in the US, because the dollar is going to remain on the weak side. I've given you the levels that I think it goes down to. This 101.90 is going to be key. And while the dollar is on the back foot, gold is going to do better. And if we really have that kind of a move in real yields down towards that 125 to 150 area that I expect, then there is no reason to think that eventually we don't go down towards the support in the longer duration bonds, but we don't break those levels. So that is what I'm looking for over the course of the next couple of weeks. I think next week is likely to be very quiet, simply because whatever data, and it's very marginal, that we get is going to be overshadowed by Jackson Hole, and Jackson Hole probably is going to be a non-event. Whenever a non-event happens, the market sides with the relief, volatility gets hit a little bit, and risk assets do a tiny little bit better. Here I've included a table with, in fact, it's an Excel file with the holdings of ARPA, because I think if ARPA is going to do better, then it's very unlikely that risk assets get sold hard again. So that is the reason why I think that buy the dip in risk assets is going to prevail next week as well. Thank you very much indeed, and tweet you tomorrow.